You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, last week we looked at a trade that, well, it should have worked out if people stuck to the plan. But what we looked at last week was doing a long call spread, which was net positive time premium, in that we did a 5-point wide spread and we paid a net debit for that trade, hence the name long spread. But we sold more time premium that we bought. So it was a net positive theta on that trade. And so that was a week ago. We did it on the 13th after the close. And the next day, the market basically stood still. It didn't really do too much. Now, it traded a little bit lower down towards our bottom strike before the end of the week, before the Friday close. But the bottom line is you should have got a lot of time decay just by getting that 1 day's worth of time premium. And if you were paper trading it, then you should have got out after you made a buck or even maybe 75 cents on the trade. That's what we talked about as far as the parameters, and you should have just closed out the trade. Now, what we did say was if the market went against us, we were going to hedge. And what we were going to do is on Thursday, if the market opened down, we were going to roll it into a butterfly and then remain long that butterfly all the way to the end. So by rolling into the butterfly, we would have sold a credit spread to add the additional spread to our long spread. And that would have kept us short 2 in the middle, and then we would have been long the wings. In this instance, and in this episode of Options Playbook Radio, I think I'm going to stick with that theme. I'm going to move the opposite direction, though, and I'm going to do something that I like to do in this type of environment, once again, in the indexes. We still have the VIX index trading, well, it's around 13 today, and I should say that we are taping Options Playbook Radio on the 23rd. It is the Wednesday. The market has closed, and the S&P 500 index today closed at 2,733.29. It was up $8.85. So the market is closed. So we're going to be using those option contracts. And what we're going to do is the reverse. We're going to do a directional butterfly, very short term in this instance. And if it goes against us, we're going to actually roll into a credit spread. In other words, we're going to roll out of the butterfly and into a credit spread. So I've talked about this from time to time on Options Playbook Radio, but it's really hard to discuss a little bit without graphics. So since last week's trade worked out just fine, we're going to now look at this week's trade, and we're going to be a little bit more bearish. Now, you can do it in both directions. I prefer to be bearish with the puts and do this long butterfly with the puts a little bit down on the marketplace and then roll into a put credit spread if the market continues on up. That's my preferred way to do it, but it's all about what you think is going to happen to the markets over the next couple of days. So if you have the options playbook on your table and you'd like to follow along, please look for long butterfly with puts inside the options playbook. And if you don't have it, that's okay. Just go to optionsplaybook.com, click on the strategies tab, and inside the strategies tab, you will easily see a long butterfly with puts. And then what we're going to do is the hedge trade is going to be if we roll that into a short credit spread with puts, all right, which is a bullish trade. When you do a put credit spread, that means that we're going to turn this trade into a bullish trade if we are wrong on our forecast on where we think the market's going to go. Okay, so we're going to do it 10 points wide here, and the hedge is going to be costly, but the initial trade is not a lot of risk to us. So the market right now is at, once again, 27.33. And I'm going to emphasize that these are never meant to be recommendations here on Options Playbook Radio. We're just trying to learn. And specifically, when I'm looking at these trades, I'm just looking for, where do I want the VIX to be when I'm doing these type of trades? Where would I prefer the S&P 500 index? Do I want to do them around earnings? What do I want to happen to theta? What do I want to happen to implied volatility? And in this instance, we're really, once again, doing a big theta decay trade. In the S&P 500 index, when you go from Wednesday to Thursday, there's a huge rate of decay, and then then the decay falls off the cliff if you go all the way to Friday, because obviously these options have to stop trading. And we will be doing the weekly options in the S&P 500 index, and the last day to trade is Friday, so you have that full trading day on Friday, as opposed to the European-style monthly option contracts, which stop trading on Thursday. Okay, so we're going to be in the weeklies. So let me set up this trade. We're going to do another 2-day trade. Sometimes, like I mentioned last week, we talked about a time bomb long spread. Here we're going to call this a time bomb butterfly, in that it's a huge theta decay, huge reward if you are correct on your forecast. But we're just looking to make the minimum when we're doing this trade, and we're not trying to hit a home run. So the trade is, we are going to use the put options in the S&P 500 index. We're going to go out until the May 25th expiration. So there's going to be 2 full days worth of trading. We're going to do a 10-point wide butterfly, which means we're going to be buying the 27.10 strike put, selling 2 of the 27.20 strike puts, and then buying 1 of the 27.30 strike puts. So the strike prices are equidistant. And we're trying to do this for a net debit of $1.45 to the account. So when we first put on this trade, and it is a butterfly, so it's limited and known risk, that means it's going to cost us for every 1 by 2 by 1 butterfly, $145 plus commissions. And commissions will be high because you've got 3 different legs on this trade, and it's a total of 4 contracts, so keep that in mind. Now, you take that $1.45, you multiply it by 100. That means we spend $145 plus the commission to enter this trade. And once we do that, that's going to be our max risk, that $145. And where do we lose? Well, we can lose that maximum if it stays above 27.30, which it is right now. It's 27.33. Or if it goes down below 27.10, our other protective leg on the downside. Those are worst case scenarios, and if that happens at expiration, then we receive the maximum loss of $145 on this trade. So we place the trade tonight. Let's say we could execute the after hours. What we'd really like is the market to start drifting down, and if it does start drifting down, the maximum we can make on this trade is $10. Well, $10 is the maximum that it would be worth. Minus the $1.45 means the maximum we could make is $8.55. And once again, if you do make $8.55, that means you received the stupid award because you should have been out of the trade a lot sooner, because hoping that the stock is going to, or that the S&P 500 index is going to stop right at your short strike, the 27.20 strike, right at expiration, then there's no rationale as to why you'd want to wait around and not take your gain. If it's hanging out right around 27.20, you get one huge day's worth of decay. You should easily be able to make a buck on this trade without even trying. Okay, now, so we all know what would happen if the market goes down. Now, a bad scenario would be if you got a huge gap down and implied volatilities came up, and for some reason, the market dropped 20 points on the open or 25 points. Then this trade wouldn't do you as well. But if it does go up, right, and usually in the S&P 500 index to get a 20-point gap on the open, that's a lot just because it's an index. It doesn't happen as much in indexes, and that's part of the reason why I prefer to trade them on these type of strategies. I like to say there's some volatility with some predictability, even though that's basically an oxymoron. If it were to apply to any underlying overall, that underlying would be an index like the S&P 500 index or the Dow, something where you have a lot of stocks that are controlling some of the volatility on the open of that index, on the opening print. All right, so that's our trade. That's what we're looking to do. Let's talk about the hedge. Maybe we'll get a chance to hedge this trade over the week. I'll keep my eye on it. There'll be a couple of days. I'll watch the open tomorrow. If by noon, if the market, instead of going down 10, goes up 10, right? Let's say we go up 10, and that is going against our long put spread. What's the hedge, you may ask? Well, what we're going to do is we're going to sell the most expensive option contract. If the market is going against us, the closest strike is the 27.30 strike. And we'll sell that option contract, and then we'll use the proceeds to buy our other leg, which is the 27.10 strike, and hence that will roll us into a short put spread. Now, here's the catch. If you're going to do that, you will now be short 2 short put spreads that are 10 points wide. So you got to make sure when you put on this trade, the initial risk is $1.45. But once this happens and the market starts going against you, your additional risk is now going to be 10 points wide, and it's going to be 2 contracts. So that will be $2,000, which means if the market makes a wild swing and comes way back down and closes below 27.10 at the expiration date, the maximum that I can lose is that $2,000 minus whatever the net credit is that I got from rolling into my credit spread. So why would we do that roll? Why would we take on more risk? Why would we add that to the position? Well, let's think about this. You have 2 trading days here. So this is a very, very active trade in that the market goes against you. It starts going on up. It's going in the right direction. And with most instances, if the markets open up, there's always a higher probability that it's going to actually close up, obviously. So the momentum is going to the upside. Once you roll this, realize we are now our risk is at 27.20, which the market right now is 27.33, right? If it's gone up another 10 points or 15 points, the market would be, let's just call it 10 points to make the math easy, the market would be 27.43. So that means we are now, at this instance, we are now 20 points away from our short strike with 1 day remaining to trade. Now, that is very plausible that the market can come back down. But if I'm going to do this roll, I'm going to also make sure that it pays the debit for my initial butterfly. So when am I looking to roll? I simply I don't look at deltas. I don't look at anything. I just look at where's the net credit if I sell the 27.30 strike put and use those proceeds to buy a further out of the money 27.10 strike put. And if I can do that roll, and I can do that roll for $2.50, that's when I'm going to do it, right? So then I'll have a $1 net credit, and if I can just make it 1 day without the market coming down 20 or 30 points in the S&P 500 index, well, I got out of my trade and I made a small profit for my efforts. Now, if the market just opens down, this is simple. This is a simple trade, but this is a hedge. So last week we looked at being long a call spread, selling a short spread to basically roll into a butterfly. Now we're going to go from a butterfly and we're going to roll into a credit spread. So just for example, on these 2-day option contracts with the VIX somewhere, it's about 12.5. It was down 64 cents on the day. So I'd rather have the VIX at 13, honestly, or 13.5. But 12.5, I'll take it. It's not 10. At 10, I don't even want to do this trade because the butterfly is going to be too expensive to start. So in this instance, right now, we talked about doing the 2730s. And the 2720s we're selling. So 2730 is the most expensive option, and the 2710 is the least expensive option. So I'm just going to go from ask to ask. So I'm going to show you where this credit spread is at right now. So if we put it on right now, and we had to roll because the market started to go against us, so we decided we'd roll. The ask price on the 2730 is $740, and the ask price on the 2710 is $210. So that credit spread is trading for $5.30. I used ask to ask to kind of make it look like, you're looking at the midpoint. So that should be pretty close to the midpoint, $5.30. So that credit spread, that roll, that sell to close of the 2730, buy to open of the 2710, that roll right now is $5.30. I see that trading for $250. That means the market's probably up 10 or 15 points. I see it trading for $250. I roll. I don't ask questions. I don't do what I roll. Once again, what do I do when that happens? If that credit spread starts trading for $250, I roll. I roll into the short credit spread. Now you can manage your risk from there going forward. You don't want to lose the maximum on any credit spread position, so you manage your risk going forward. But this is a very interesting way to trade a 2-day option contract in an index when the volatility is at the right levels. I don't want to do this necessarily when the VIX is at 30 because I just don't want that big of a swing. I don't want to do it when the VIX is down at 10 because I'm paying too much for the butterfly up front. The ideal time when I want to do this in the S&P 500 index is when the VIX is trading somewhere between 13 and 16. That's where I like it the most. So once again, not meant to be a recommendation. Please look to paper trade and try to learn from Options Playbook Radio. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time and same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.